You're self-employed and you want to buy a home, but your taxes say, well, you're broke. Not necessarily broke, but you're not claiming enough income to buy the house that you really want to buy. The problem is that underwriters look at your taxable income, not your actual income. So today I'm going to talk about how you can legally structure your taxes to show more income so you can actually qualify for a mortgage for the house that you want to buy. So, first thing we want to talk about is why do self-employed people get denied for a mortgage? Well, this is the ultimate nightmare, and I've fixed this problem for people many times, and there's really no reason to get into this issue. When you get pre-approved for a mortgage and you're self-employed, the first thing I tell people is before we do anything else, A, well, I've got to see your credit score, but B, I've got to see your tax returns because there's no way to know how much you actually make as far as a mortgage goes and qualification without doing the income analysis from the tax returns. And I'm going to put a link at the bottom. If you file a Schedule C tax return, you're sole proprietor basically, I have a self-employed income calculator. I'm happy to do it for you, but if you just want to take take a stab at it, it's a really good calculator. So anyway, the first thing I do again is to look at the tax returns. So when I say that underwriters look at taxable income, that means, for example, if you make $500,000, your business brings in $500,000 of top line revenue, and then you go through the tax returns, you write off marketing, telephones, whatever, and then you come all the way down and you have $400,000 in write-off. That's great. You have a lower tax bill. Well, then that means you only have $100,000 that you can use to get qualified for a mortgage. But there are some things that you can do to make it look more favorable. So what is a self-employed borrower really? So Fannie Mae and Freddie Mac say anyone that claims or owns 25% or more of a business is considered self-employed. And so you obviously, if you're filing an S Corp or you have an S Corp, there'll be K1s that are just created at the end of the year. If you get a K1 from a business that says you're 12% owner, well, you're not technically self-employed, so that's good. But they're going to look at underwriters. They're going to look at the last 2 years of tax returns. They're going to look at a profit and loss statement. It doesn't have to be audited by a CPA. It can be self-prepared even. But an example of this is we're in 2025 now. An underwriter is going to look at the 2023 and 2024 tax returns and a year-to-date profit and loss statement for 2025. It just needs to show that you're on track to make at least as much money as you made in 2024 because they don't want to see a business that has got declining revenue. Now, this is one of those tricks on how, well, I don't know if it's a trick, but how self-employed people can get around some of these. So the guidelines say if you have been in business for over 5 years, then you can use typically just the most recent year's tax return. And why this is helpful, let's say in 2023, you had not such a great year. Who knows what happened? But last year, 2024, you had a really good year. Well, if you've been in business over 5 years, you can just use that last year's income instead of averaging the 2 years, which would drag down your income. So that is super helpful and something, a mistake I see people make a lot of times. They overlook that. The way you can tell is if you file 1120S, you're an S corporation. On the first page, it says the year that you're incorporated. Now, if you're a Schedule C, you only file one tax return with a Schedule C in it as a sole proprietor, then that's different. Basically, sometimes it's just up to the underwriter to determine if you've been in business for 5 years or more. So that could be something you could take a look at. So how can you prepare your tax returns to maximize, the approval? What's some pointers on that? Well, obviously you want to reduce deductions. Now, underwriters can add back some of your deductions. For example, depreciation is the big one. So if you have, let's say, equipment that you can depreciate, things like that, uh, that's great because any depreciation on the tax return can be added back in. Also, business mileage can be added back in. Sometimes home office deductions can be added back in. But what can't be added back in are things like marketing expenses, office expenses, things like that. Now, let's say, for example, you are a sole proprietor and you bought a car and you can do, say, like a one-time depreciation. That would be great. You might be able to add $50,000 back into your tax return. So that's an example. I think just standard, practices for owning a business is to keep clean records, right? So you want to keep your business and personal accounts separate. A mistake I see a lot of times, there used to be a guideline, and I think a lot of people think this still now, that just because you pay for a vehicle out of your business account, like checking account, that you can not count that in your debt to income ratio. Well, those guidelines changed a few years ago. What it says now is that you can write it off, but it has to come out of your business checking account, and you have to show on the tax return where those deductions were taken. So it's not as simple. It makes it very difficult. So don't just assume that you can do that. Well, what if you have had your CPA, look at your taxes, you've tried to claim as much income as you can. And one thing I'll say here, I often look at my clients' tax returns or ask them to send me a draft copy of their tax return before they file it. So now we're in February 2025. I've asked some of my clients, before you file the return, send it to me so I can do the calculations. Because if you're not claiming enough income, we can have your CPA look at it again and claim more income, right? Well, what if you do all these things and you still don't claim enough income, or you just realize that it's never going to make sense to pay the taxes you'd have to pay to buy the house that you want. So I have a lot of clients. I think a lot of these alternative types of loans, alternative documentation types of loans, are people that are buying, fairly large houses. I've done loans, $2-3 million loans for people. They're buying very big houses. They have lots of cash. They're just never going to pay the kind of taxes, or don't want to pay the kind of taxes that it would take to have that sort of mortgage payment. So the first thing we would look at is probably a bank statement loan. That's probably the most common. Bank statement loan, you can take the last 12 months of bank statements or 24 months of bank statements, and at least use 50% of the deposits. These have to be straight deposits. They can't be transfers from other accounts, or, for example, you get a tax refund. That's not going to count. So it'd be straight deposits. You can also use, deposits that come in from Venmo or Zelle or PayPal or whatever. That's fine. And if you're a type of business that has not so much overhead, like you're a consultant, you work from home, for example, might be able to use up to 80% of the deposits. So that would be the first type of loan. Well, let's say that maybe doesn't work for whatever reason. Let's just say you have a lot of assets, a lot of cash, or stock or retirement funds. Well, you might be able to put down, say 30% on the purchase, and you have enough funds to just do what's called an asset-based loan. So you're not having typically to pledge the assets. You have to just show that you have enough, money to make X number of years of mortgage payments. It's typically going to be 5 years of mortgage payments or 60 months. Also, there, believe it or not, are still no income documentation type loans. So I've done a number of these lately. You can also do them for cash out refinances. So this is where you put down 25% minimum. You don't have to list any income as long as you have enough money for the down payment and about 6 to 12 months of mortgage payments after closing, and a good credit score, of course. That's all you need. Obviously, the rates on all these loans are going to be a little bit higher, maybe 1 to 1.5% higher, just depending. But again, most people realize that that's a better deal than paying a lot of income taxes. And then also for real estate investors, there's what's called DSCR loans. Those are loans where you don't have to show any income at all. It's just based off of the cash flow of the property. And those, again, are only for investment properties. But again, you can do refinances, cash out refinances on those, for example. So just to recap, if you're self-employed, got to show your tax returns to your mortgage professional, whether that be myself or somebody else. If you talk to somebody and they pre-approve you without looking at your tax returns, run. That's no good. It's not going to work. Show your tax returns if you're unsure to to me or your mortgage person before you file them, so they can be changed if you're not going to show enough to claim or to qualify for the house that you want to buy, for instance, in 2025. So if you found this video helpful, it'd be super helpful to me if you'd click like and subscribe, share it with somebody else. Again, there's going to be a mortgage calculator in the comments section if you want to take a stab at figuring out your own tax returns. If I can help in any way, please go to my website, mortgagesbyscott.com. Again, thanks for watching.